Today we're cracking open the mystery box that is the SPGP ETF, the Invesco SP 500 GARP ETF. Now, this fancy name might leave you wondering, is it a growth machine, a value champion, or something else entirely? We'll break down exactly what this ETF is all about, its fees, how it stacks up against the competition, and whether it can fit into your portfolio. So, whether you're a growth guru or a value veteran, stick around because this might surprise you. Question 1. What is SPGP ETF? The SPGP ETF, also known as the Invesco SP 500 GARP ETF, is an exchange-traded fund designed to track the performance of the SP 500 GARP index. Let's break down what that means. Exchange-traded fund, ETF. An ETF is a basket of securities that trades on a stock exchange, like a single stock. SPGP offers investors exposure to a variety of companies within a single investment. Invesco, this is the company that created and manages the SPGP ETF. They are responsible for selecting the underlying holdings and ensuring the fund tracks its target index. SP 500. The SP 500 index is a market capitalization weighted index of the 500 largest publicly traded companies in the U.S. By tracking an SP 500 based index, SPGP provides broad exposure to the large-cap U.S. equity market. GARP stands for growth at a reasonable price. The SP 500 GARP index focuses on companies that exhibit characteristics of both growth stocks and value stocks. Here's a deeper dive into SPGP's investment strategy. Growth stocks. These are companies with above-average earnings growth potential. The index uses factors like earnings and sales per share growth to identify potential growth companies. Value stocks. These are companies that appear to be trading at a discount to their intrinsic value. The index considers factors like price-to-earnings, PE ratio, to identify potential value stocks. Quality and valuation blend. The SPGP ETF doesn't simply invest in pure growth or value stocks. The SP 500 GARP index selects companies that demonstrate growth potential while also exhibiting characteristics of financial health and valuation attractiveness. This blend approach aims to achieve growth while mitigating some of the risks associated with pure growth stocks. Weighted by growth score, the holdings within the SPGP ETF are not equally weighted. Companies with higher growth scores within the SP 500 GARP index will have a larger weighting in the ETF's portfolio. This further emphasizes the focus on growth potential within the SPGP strategy. Question 2. What is the primary objective of the SPGP ETF? The primary objective of the SPGP ETF, or Invesco SP 500 GARP ETF, is to achieve total return, which combines both capital appreciation, growth in share price, and income generation, through dividends, by mirroring the performance of the SP 500 GARP index. Let's dissect this objective and the underlying strategy. Total return. Unlike some income-focused ETFs, SPGP aims for a balance between share price growth and potential dividend payouts. This caters to investors seeking long-term capital appreciation while also generating some income to potentially reinvest or supplement their income needs. SP 500 GARP Index. This is the benchmark that the SPGP ETF tracks. Here's where the GARP aspect comes into play. GARP stands for growth at a reasonable price. The SP 500 GARP Index focuses on identifying companies within the SP 500 that exhibit characteristics of both growth and value stocks. Growth stocks. These are companies with the potential for above-average earnings growth. The index uses factors like earnings and sales per share growth to find these companies. Growth stocks tend to have higher valuations due to their future prospects. Value stocks. These are companies that appear to be trading below their intrinsic value. The index considers factors like price to earnings, PE, ratio to find potential value stocks. Value stocks may offer lower current returns, but could see significant price appreciation if their true value is recognized by the market. Balancing growth and value, the SP 500 GARP index doesn't simply pick pure growth or value stocks. Instead, it seeks a balance. Quality and valuation blend, the index prioritizes companies demonstrating growth potential while also exhibiting signs of financial health and attractive valuations. This blend approach aims to capture growth opportunities while mitigating some of the risks associated with pure growth stocks, which can be more volatile due to their dependence on future earnings potential. Weighted by growth score, companies within the SPGP ETF aren't equally weighted. Those with higher growth scores within the SP 500 GARP index will have a larger weighting in the ETF's portfolio. This prioritizes companies with stronger growth prospects, further emphasizing the focus on growth at a reasonable price. In essence, the SPGP ETF seeks to provide investors with a growth-oriented investment strategy that aims to mitigate some of the risks associated with pure growth stocks by incorporating elements of value investing. This approach strives to deliver a balance of capital appreciation and potential income through dividends, ultimately aiming for a strong total return. Question 3. How does the SPGP ETF achieve its investment objective? The SPGP ETF, or Invesco SP 500 GARP ETF, achieves its investment objective of total return through a combination of strategies. 1. Passive management and index tracking. SPGP is a passively managed ETF. This means the fund manager doesn't actively select individual stocks. Instead, the ETF tracks the SP 500 GARP index. The fund aims to hold the same proportions of the underlying securities, stocks, that make up the index. 2. SP 500 GARP index composition. The magic lies in the specific index it tracks. Focus on large-cap U.S. stocks. The SP 500 GARP index itself focuses on the 500 largest publicly traded companies in the U.S., represented by the SP 500 index. This provides broad exposure to the U.S. equity market and the potential for growth alongside established companies. Growth at a reasonable price, GARP, philosophy. The index goes beyond just large-cap status. It employs a methodology to identify companies within the SP 500 that exhibit characteristics of both growth and value stocks. Growth stock identification. The index considers factors like earnings and sales per share growth to find companies with the potential for above-average future earnings. These companies are likely to experience significant share price appreciation if they deliver on their growth prospects. Value stock identification. The index also uses factors like price to earnings, PE, ratio to identify companies that appear to be trading below their intrinsic value. These companies may offer lower current returns through dividends, but could see significant price appreciation if the market recognizes their true value. Quality and valuation blend. The SP 500 GARP index doesn't simply pick pure growth or value stocks. It prioritizes companies that demonstrate growth potential. The companies should have the ability to generate above-average earnings in the future. Financial health. The companies should exhibit strong financial fundamentals, suggesting a lower risk of bankruptcy or financial distress. Reasonable valuation. The companies shouldn't be overvalued compared to their earnings potential or future prospects. This blend approach aims to capture growth opportunities while mitigating some of the risks associated with pure growth stocks. Weighting by growth score. Not all companies within the SPGP ETF are created equal. The index assigns a growth score to each company based on their growth potential. Companies with higher growth scores will have a larger weighting, percentage ownership, within the ETF's portfolio. This prioritizes companies with a stronger chance of delivering the targeted growth, further emphasizing the growth at a reasonable price philosophy. 3. Total return through share price appreciation and dividends. Share price appreciation. By tracking an index with growth-oriented companies, SPGP aims to benefit from the potential for these companies' share prices to rise over time as their earnings grow. Dividends. While the primary focus is on growth, many large-cap companies within the SP 500, and consequently, the SPGP ETF, tend to pay regular dividends. These dividend payouts contribute to the overall total return for investors. Question 4. What is the expense ratio of the SPGP ETF? How does it compare to similar ETFs in the market? The expense ratio of the Invesco SP 500 GARP ETF, SPGP, is 0.34% as of March 31, 2024, according to Invesco's website and other financial data providers. This expense ratio represents the annual fees charged by the fund to cover its operating expenses, including management fees, administrative costs, and other operational expenses. These fees are deducted from the fund's net asset value, NAV, on an ongoing basis, which ultimately reduces the overall return for investors. Here's a breakdown of how this expense ratio compares to similar ETFs in the market. Lower expense ratio alternatives. There are several ETFs that offer exposure to large-cap U.S. stocks with a growth or value tilt, and some may have lower expense ratios than SPGP. Here are a few examples. Vanguard SP 500 Growth ETF, VOOG, expense ratio 0.09%. iShares Russell 1000 Growth ETF, IWF, expense ratio 0.18%. SPDR SP 500 Value ETF, SPYV, expense ratio 0.02%. This is a value-oriented ETF, but it highlights the existence of lower expense ratio options. Comparable expense ratio alternatives. There are also ETFs with similar investment strategies, focusing on growth at a reasonable price, and expense ratios comparable to SPGP. iShares SP 500 Value Momentum ETF, IQV, expense ratio 0.35%. Question 5. How liquid is the SPGP ETF? Can I easily buy and sell shares when needed? The Invesco SP 500 GARP ETF, SPGP, is generally considered a liquid ETF, meaning you can typically buy and sell shares quickly and efficiently. Here's a breakdown of factors influencing SPGP's liquidity. Factors supporting liquidity. Underlying holdings. SPGP tracks the SP 500 GARP index, which itself is comprised of the 500 largest publicly traded companies in the U.S. These large-cap stocks tend to have high trading volumes, making it easier for the ETF to buy and sell them when needed to meet investor demand. ETF structure. Unlike mutual funds, ETFs trade throughout the day on stock exchanges like any other security. This allows for immediate buying and selling during trading hours. Market maker activity. Market makers play a crucial role in facilitating ETF liquidity. They continuously quote bid and ask prices for SPGP shares, ensuring a market exists for investors to transact. Trading volume. SPGP has a healthy average daily trading volume, typically available on financial websites. This indicates significant investor interest and translates to easier buying and selling of shares. Potential limitations to liquidity. Market conditions. During periods of extreme market volatility or low overall trading activity, liquidity for all assets, including ETFs, can decrease. This may lead to wider bid-ask spreads, the difference between the price a buyer is willing to pay and the price a seller is willing to accept, and potentially slower execution of trades. Order size. If you're looking to buy or sell a very large number of SPGP shares, it might take longer to find a counterparty, someone willing to take the other side of the trade, due to the sheer volume involved. In such cases, it may be beneficial to break down the order into smaller chunks or work with your broker to navigate the transaction efficiently. Question 6. What are the risks associated with the underlying assets held by the SPGP ETF? The Invesco SP 500 GARP ETF, SPGP, invests in a basket of large-cap U.S. companies selected based on the SP 500 GARP index. While diversification helps mitigate some risk, there are inherent risks associated with the underlying assets held by SPGP. Market risk. This is the primary risk affecting all equity investments, including SPGP. Market risk refers to the possibility that the overall stock market will decline in value. This decline could be caused by various factors like economic recessions, rising interest rates, geopolitical events, or changes in investor sentiment. When the market goes down, the value of SPGP's holdings, and consequently the ETF's share price, will likely decline as well. Company-specific risk. Even within a diversified ETF, like SPGP, individual companies can experience problems that negatively impact their stock price. These problems could be company-specific issues like poor management decisions, accounting scandals, product liability issues, or industry disruptions. The impact of a company-specific event on the overall ETF will depend on the weighting of that particular company within the SPGP portfolio. Growth stock risk. Since SPGP focuses on companies with growth potential, it inherently carries more risk than a value-oriented ETF. Growth stocks are often priced based on future earnings expectations, which may not always be met. If these companies fail to deliver on their growth prospects, their stock prices could experience significant declines. Earnings risk. The SP 500 GARP index prioritizes companies with the potential for above-average earnings growth. However, unexpected economic slowdowns, industry downturns, or company-specific issues can negatively impact earnings. If the earnings of the underlying companies in SPGP fall short of expectations, it could lead to a decline in the ETF's share price. Sector concentration risk. While SPGP offers broad exposure to the U.S. market, the SP 500 GARP index methodology might result in a concentration in certain sectors. For example, the index might overweight technology or healthcare stocks. If a particular sector experiences a downturn, it could disproportionately impact the performance of SPGP compared to a more broadly diversified ETF. Liquidity risk. Even though SPGP is generally considered a liquid ETF, there's a slight possibility that during periods of extreme market volatility or low overall trading activity, liquidity for the ETF could decrease. This could make it challenging to buy or sell shares quickly and at a desired price. Management risk. Passive management. While SPGP is passively managed and doesn't involve security selection by a fund manager, there's still risk associated with the index methodology itself. The construction and weighting of the SP 500 GARP index could potentially underperform the broader market or other growth-oriented strategies. Currency risk. If applicable, if SPGP invests in any companies located outside the U.S., fluctuations in foreign exchange rates could impact the value of the ETF's holdings and ultimately its share price. Question 7. Is the SPGP ETF concentrated in a specific sector, industry, or geographic region? The SPGP ETF, or Invesco SP 500 GARP ETF, aims for broad diversification by tracking the SP 500 GARP index. However, due to the index methodology and focus on growth at a reasonable price, there's a potential for some level of concentration in certain areas. Here's a breakdown. Sector concentration. Broad exposure. The SP 500 GARP index itself tracks large-cap companies across various sectors within the U.S. economy. This provides SPGP with some level of diversification across different industries. Potential sector weighting bias. While the index offers broad exposure, the methodology might overweight certain sectors based on the growth potential and valuation characteristics of the companies within those sectors. For instance, the index might favor technology or healthcare due to their growth prospects, potentially leading to higher weightings for those sectors within the SPGP portfolio. Industry concentration. Similar to sector concentration, the SP 500 GARP index methodology might favor specific industries within a particular sector due to their alignment with growth at a reasonable price characteristics. While SPGP offers broad exposure across industries, there's a possibility of a tilt towards certain industries within favored sectors. Geographic concentration. US-centric. By tracking the SP 500 GARP index, SPGP primarily invests in large-cap companies listed on U.S. stock exchanges. This means the ETF has limited exposure to companies from outside the U.S.